Futures, meanwhile, rallying this morning. We're expecting a big opening for the stock market after yesterday's wild session. The Dow Industrial is expected to be up 250 points this morning, right at the opening of trading. Investors had concerns over inflation yesterday after the unexpected decline in retail sales, coupled with the increase in the consumer price index. Let's bring in global economics editor with the Wall Street Journal, Jon Hilsenrath. And John, we were together yesterday watching the market completely fall out of bed after we got the CPI number. It was up 200, then we got the CPI. It was down 300. By the close, investors turned their focus back to the fundamental backdrop, strong earnings and strong economic growth, and rally.
Right, and we could see more of that today. We're getting another inflation number. This is the producer price index, which measures inflation among businesses. And but you know, it looks like this volatility trade that we've had for the last couple of weeks might be washing out, and people are getting back to buying on dips.
What do you think about that, Lindsay Bell? We got the producer price index coming out in about an hour. PPI is expected to be up 0.4%. That data is coming out in an hour. Is it going to be the same situation that we saw yesterday, you think? Getting a strong PPI, market falls out of bed?
Exactly, especially since this morning the markets are up pre-market, so that's a good sign.
Well, they were up yesterday before the CPI.
But they're up huge today, and so
they were up huge yesterday.
I'm just looking forward to getting past all this inflation data and moving forward, because one data point does not make a trend. And like you said from the beginning, look, the economy is strong. We have consumer confidence that is still at very high levels. We have a global economic growth situation going on here. This is all very good for the markets. But, John, I would ask you, just with regards with the Fed rate hikes coming on board, how are the people that you're talking to on a daily basis viewing the increase in the deficit and how that's going to impact the Fed's trajectory going forward?
Well, I think it complicates matters for the Fed, the fact that not only the deficits are rising, but that we're getting added stimulus to an economy that's already at what economists call full employment. So, you know, the unemployment rate is at 4.1%. When it's very high, you justify fiscal stimulus, either tax cuts or spending increases, to get the unemployment rate down. But it's already at such a low level, it's kind of hard to justify it now. And the fear is that when you pump more money into an economy in a low employment state, that it causes either financial market overheating or inflation. So it raises the probability that the Fed is going to raise interest rates a little bit more this year than it might otherwise have done. But I think what we saw happening in the markets yesterday is people are realizing when it comes to inflation and when it comes to the Fed, it's a very glacial process. The Fed is not going to be reacting on a trigger the way the markets are right now. You know, they might do 4 rate increases instead of 3 this year.
Yeah.
That's a decision they don't even make until December. So there's a really long, slow process that has to play out before any of that happens.
Dig in. Listen to what they're writing in the J.P. Morgan Morning Note this morning. They're telling clients the robust U.S. rally on Wednesday continues this morning, partly because the absence of the U.S. dollar strength on the back of the firmer CPI reflects the market's more relaxed view of the FOMC. A more relaxed view of policy, and that's being used as the excuse to buy stocks.
And that makes my stomach turn.
Because people are not worried.
Yeah, you need to worry.
We'll take a break. Jon Hilsenrath, thank you, sir. We will see you soon.